Online shopping platform Temu. US-listed shares of the e-commerce giant fell by more than 13% on Tuesday after it reported a near 50% drop in profit as recent US trade policies added to its struggles in its home country.
Shein and Temu are seeing a drop in shopper activity here in the US. The plunge comes amid recent tariffs on Chinese imports.
China fooled the US for years. It was beating America in their own backyard, and it cost the US billions. But not anymore. The revenge has been taken, and it wounded the dragon so brutally, it's gonna bleed for years. A few years back, two of the fastest growing online giants, Temu and Shein, found a genius hack to fool the US and save millions and even billions out of it. It was a boon for China, but a nightmare for America, collapsing US businesses almost overnight. This is when the US government finally said, enough. With one powerful executive order, Washington slammed shut the loophole that let these companies flood the country with duty-free, ultra-cheap imports. The impact was so brutal that in just 2 months, Temu's daily active users dropped 52%, and Shein's fell 25%. So what exactly was the loophole that Chinese companies exploited, and how did it end up costing the US billions? But as you've already guessed, the CCP is going to hate this topic, and their bots might try to bury it in the algorithm. The good news for you is that you can help us fight back simply by hitting that like button. Thank you. It all started with an idea as old as retail itself, selling things cheaper than anyone else. Temu launched in September 2022 as a subsidiary of China's PDD Holdings. Unlike traditional retailers that stocked US goods in warehouses, Temu connected American shoppers directly to Chinese manufacturers using something called the cross-border direct-from-factory model. Simply put, this is a business strategy where products are shipped directly from the manufacturing facility in one country to the end consumer in another country. This was a game changer, but why? Because it eliminated traditional intermediaries like distributors, wholesalers, or even local US warehouses that made Chinese imports expensive in the first place. The result? Ultra-low prices for American consumers. By late 2023, Temu had already become a household name in the US. It reached over 100 million active users in America alone, and it boasted around 420 million monthly website visits worldwide. It was everywhere. Instagram ads, YouTube sponsorships, Facebook feeds, they spent massively on marketing. According to industry trackers, Temu became the top shopping app in the US App Store in 2023 and early 2024. On the other hand, Shein had a head start. Founded in China in 2008, Shein was already the king of ultra-fast fashion before Temu ever existed. Instead of seasonal clothing lines, Shein used real-time data to design new items daily. It shipped directly from factories in China to the rest of the world. By 2023, Shein had become the largest online-only fashion retailer in the world. In the US, it controlled a massive share of its fast fashion sales, especially among Gen Z. Its app dominated download charts through 2022 and 2023. But behind their success in America was a loophole that these companies quietly exploited and beat their US rivals. This was none other than the de minimis loophole. You see, under US law, any single imported package worth less than $800 could skip paying import duties or undergoing customs inspections. The de minimis rule was originally created to make trade simpler by allowing products to qualify for special tariff benefits. It also allowed tourists to buy things in other countries and then take them back home with them to the US without needing to worry about import duties. Initially, the limit was $200, but in 2016, this limit was raised to $800. This rule was meant to help businesses by reducing paperwork and costs for low-value foreign products. But Temu and Shein had other plans. They turned this small rule into their entire business model. Every time we cover how China's been exploiting the US, these videos, they get buried in the algorithm. So if you believe this story matters, hit like and subscribe right now. That one click helps this reach more people, especially the ones who are still shopping on Temu. They didn't need to stock their products in the US's warehouses. They didn't pay tariffs. They simply shipped cheap goods in millions of tiny packages straight from Chinese factories to your doorstep. And the consumers loved it. Why wouldn't they? $3 t-shirts? $2 earrings? $5 sneakers? By leveraging the power of Chinese manufacturing, ultra-cheap shipping, and aggressive digital marketing, Temu and Shein started dominating the e-commerce market in the US. By avoiding US tariffs, these companies cut costs dramatically. American retailers who imported in bulk and paid all required tariffs, just couldn't compete on the price. This wasn't a minor side channel either. This scale was enormous. By 2024, approximately 1.36 billion shipments entered the US under the de minimis rule, with a total estimated value of about $66 billion. Nearly half of all those packages came from China or Hong Kong, and Temu and Shein were among the biggest users. According to US customs officials, these companies were together responsible for as much as 30% of all daily packages entering under de minimis. Critics in the US retail industry were furious. They argued it was an unfair advantage. American sellers import in bulk and had to pay tariffs, maintain warehouses, manage customs paperwork, and still compete with a $4 shirt shipped straight from China with no duty? You might ask, why didn't the US sellers not order millions of packages like Temu and Shein did? Well, they couldn't because they lacked access to China's ultra-cheap labor, subsidized shipping, and a factory. Direct supply chains needed to ship millions of tiny parcels profitably. So retail trade groups lobbied hard in Washington to close this loophole. All of these cheap Chinese imports really hurt American manufacturing, especially the US textile and clothing industry, and the impact was devastating. As early as September of 2024, industry data already showed 18 US textile plants had closed. And a report later showed that by May of 2025, 28 textile and apparel plants in the US shut down. According to industry groups and government reports, these closures were directly linked to the flood of low-cost clothing coming from China, much of it sold through e-commerce giants like Shein and Temu. In 2024 alone, Chinese apparel imports to the US totaled $16.7 billion, making up 21% of all US apparel imports. The massive volume of ultra-cheap imports hit the US textile industry hard, especially in the Southeast, where most factories were based. In US trade regulators and policymakers' view, the massive wave of cheap, duty-free imports was not just a smart business by Shein and Temu, but a clear example of how loopholes in trade law hurt American workers and manufacturers. But beyond just e-commerce, it had a much darker side. Law enforcement raised concerns that the de minimis system made it harder to intercept counterfeit goods, unsafe products, and even illicit drugs. In 2023, a US Department of Homeland Security report warned that the rule was exploited by bad actors and overwhelmed customs screening capacity. The US government started to wake up to the problem. By 2023 and 2024, congressional hearings featured testimony about the explosion of these small-value shipments from Chinese online sellers. Lawmakers described it as an abuse of American trade law that hurt domestic businesses and threatened consumer safety. So while Temu and Shein delighted millions of US bargain hunters, they were also building up political pressure that would eventually burst. What had once seemed like a clever business hack was about to become a liability. But as we'll see, this strategy was built on a legal loophole, and that made it vulnerable to a single stroke of a politician's pen. And it did. On April 2nd, 2025, President Donald Trump, campaigning on promises of tougher trade with China, signed an executive order that changed everything. The order eliminated the de minimis exemption for all imports coming from China and Hong Kong. That meant even packages from China and Hong Kong worth just a few dollars would have to go through customs procedures and pay duties. And it wasn't just about making things fair for US businesses. The White House argued that this was a necessary move to address two big issues. First, they blamed China for its role in fueling America's synthetic opioid crisis. US authorities have tracked illegal fentanyl precursors shipped through these same low-value channels. Closing the loophole was meant to make it harder for traffickers to slip goods through unchecked. Second, the administration said the rule change was needed to fight trade imbalances that had helped Chinese companies flood the US market with ultra-cheap goods. As Trump put it bluntly during the announcement, "We will no longer allow China to cheat American workers and businesses." The new policy took effect on May 2nd, 2025. From that day, no shipment from China or Hong Kong under $800 would be exempt from customs duties. Every parcel would be treated like a bulk commercial import, and the new tariffs weren't small. Small packages delivered by the US Postal Service faced an immediate 30% tariff or a minimum $25 fee, which later even increased to $50 in June. Shipments by private carriers like UPS or FedEx had to pay full import duties, which could go as high as 145% for certain categories of Chinese goods. This was a direct and dramatic hit on the core business model of Temu and Shein, because no longer could they break shipments into millions of tiny parcels to avoid taxes. The idea was simple. If foreign sellers want to compete in America, they would have to play by the same rules. Critics and supporters both agreed on one thing. This was the biggest change to cross-border e-commerce rules in decades. But it had mixed reactions. Supporters on the crackdown said it was long overdue. Retail industry groups applauded the move, calling it a victory for fairness and US jobs. Lawmakers who had pushed for reform said it was finally giving US Customs the power to inspect and control what was entering the country. On the other hand, opponents warned it would hit US consumers with higher prices and longer shipping times. Temu and Shein had no choice but to react immediately, and the results were felt within weeks. Almost overnight, Temu and Shein lost the biggest competitive advantage they had in the US market. Industry analysts tracking app usage reported that Temu's daily US user count fell by roughly 58% in May of 2025, compared to March of 2025. That's more than half of its daily traffic gone in just a few weeks. Temu didn't waste time figuring out its response. It immediately slashed its US advertising spending, reportedly canceled over 10,000 planned US ad campaigns, slashed marketing budgets, and pulled back the massive social media and influencer campaigns that had once driven its insane growth. Also, Temu didn't just raise prices or slow shipping, it completely overhauled its entire delivery method. Instead of shipping everything directly from factories in China, Temu announced it would shift to a local fulfillment model. That meant it would require suppliers to ship their goods to the US warehouses first, pay the necessary import duties up front, and then sell to American consumers. PDD Holdings, Temu's parent company, admitted in a May 2025 earnings call that the tariffs were putting significant pressure on their margins and growth in the US. Shein also took a major hit, but its decline was a little less severe than Temu's. According to industry data, Shein's daily active users in the US fell by about 25% from March to May of 2025. Shein had already started diversifying its shipping and manufacturing before the crackdown, which helped cushion the blow somewhat. Still, the company cut its US marketing expenditures by roughly 70% during the same period. And it was forced to do something it had long avoided: raise prices for US customers. In April of 2025, Shein announced publicly that its American consumers would see price hikes to cover new tariffs and shipping costs. These changes went live by the end of the month, just before the ban on the de minimis exemption officially kicked in. The reaction from customers was swift. Social media was filled with complaints about suddenly higher prices. Many loyal users who were used to buying entire outfits for $30 or less began looking for alternatives. Shein's leadership told investors the company would focus on long-term sustainability over short-term discounting, but admitted that US growth would slow as a result. So in short, both companies were forced to completely rethink their US strategies almost overnight. While neither exited the US market, both were forced to scale back dramatically and redesign their operations from scratch. The bottom line was clear. The tariff crackdown worked exactly as intended. It removed the cost advantage that Temu and Shein had used to undercut US competitors. But to be honest, exploiting loopholes isn't a new thing for Chinese companies. They have been doing it for a long time, and Mexico has become its hub. After the first wave of US tariffs in 2018, China shifted its strategy, using Mexico as a backdoor to bypass duties and exploit trade loopholes. But why Mexico? It's because of the United States-Mexico-Canada Agreement, or USMCA. This trade deal, which replaced NAFTA in 2020, allows most goods made in Mexico to enter the US with zero or very low tariffs. The USMCA was designed to modernize trade, strengthen labor and environmental rules, and improve protections for digital products. It also required more automotive parts to be made in North America to qualify for tariff-free trade. Importantly, it encouraged tight economic ties between the US, Mexico, and Canada. But Chinese firms decided to exploit this. By assembling or finishing products in Mexico, they can legally stick a Made in Mexico label on them and ship them to the US while avoiding the tariffs that apply to Chinese-made goods. One key method is component shipping. Companies send semi-finished parts from China to Mexico, where they're assembled or repackaged before heading north to the US border. A hotspot for this strategy is the Hafusan Industrial Park, located about 125 miles south of Texas. This site has become a hub for Chinese companies. By 2025, it hosted over 20 Chinese firms, with another 20 planned, drawing $1.5 billion in Chinese investment. And this isn't a small trend, it's a huge shift in trade flows. Since the first wave of US tariffs in 2018, Chinese investment in Mexico has surged. By 2025, there were over 400 Chinese-owned factories in Mexico, creating more than 135,000 jobs in the country. The shift has also transformed the trade balance between the US and Mexico. The US trade deficit with Mexico jumped from $78 billion in 2018 to $172 billion in 2024. Many analysts say much of that increase is because of Chinese goods being made and rerouted through Mexico to avoid direct tariffs. Meanwhile, Mexico itself buys huge volumes of goods from China. In March of 2025 alone, Mexico imported $9.67 billion worth of Chinese products, while exporting only $731 million back to China. That left Mexico with an $8.94 billion trade deficit with China in just 1 month. So how did the United States react to all of this? By early 2025, the US government decided it had had enough. In February of 2025, the US imposed a 25% tariff on all goods from Mexico and Canada, except for Canadian oil and energy exports, which faced a 10% tariff. The official justification wasn't just trade evasion, but also issues like migration and fentanyl trafficking. But the tariff move was clearly designed to close loopholes that Chinese companies were exploiting. Under intense US pressure, Mexico also began imposing tariffs on certain Chinese goods like steel, textiles, footwear, and certain auto parts. So the US has won the trade war? Well, it might look like it, but if you zoom in, the bigger picture tells a different story. This crackdown didn't just affect two companies. It had a much wider effect on the US economy, American consumers, and even global trade. Let's start with the most obvious change: higher prices for US shoppers. Before this rule change, American consumers could get clothes, gadgets, or beauty products shipped straight from Chinese factories without paying any import tax. That's why you could find $3 shirts, $2 phone cases, and $5 shoes on Temu and Shein. But once the exemption was removed, every single package from China and Hong Kong was subject to customs duties. That meant those ultra-cheap prices were gone. Temu and Shein had no choice but to either eat those costs, which would destroy their profits, or pass them on to consumers. As a result, US shoppers began seeing significantly higher prices on both platforms almost immediately. In addition to higher costs, shipping times got longer. Without direct drop shipping, sellers had to navigate customs inspections, bulk imports, and local warehousing before delivering products to American doorsteps. For customers used to getting packages in 7 to 10 days from China, that was a big change. The shift especially hit low-income shoppers the hardest. For many Americans on tight budgets, Temu and Shein were a lifeline for cheap clothes, home goods, and personal items. Industry observers warn that removing the loophole was a form of regressive taxation, since the price hikes would affect lower-income consumers more severely. But it wasn't bad news for everyone. In fact, US domestic retailers were some of the biggest winners. For years, American clothing brands, discount chains, and online sellers complained that they couldn't compete with the flood of duty-free imports from China. They had to pay tariffs, manage warehouses, and comply with US labor and safety regulations, while Temu and Shein avoided most of those costs. By ending the de minimis exemption for China, the White House effectively leveled the playing field. Retail analysts noted that many US discount and fast fashion retailers immediately saw a potential advantage. Investment analysts suggested that major American retailers like Walmart, Target, and Old Navy could see gains as shoppers shifted back to domestic channels. It also had a strategic dimension. Supporters of the crackdown argued that by pushing companies like Shein to move production to other countries like Vietnam or Brazil, the US was reducing reliance on Chinese manufacturing. This, they said, was good for national security and supply chain resilience. But there was also a big geopolitical cost. The crackdown didn't happen in a vacuum. China saw it as a direct economic attack. In response to Trump's executive order, Beijing announced new retaliatory tariffs on US goods entering China. This tit-for-tat move threatened to escalate trade tensions even further, reviving fears of a new trade war between the world's two largest economies. Business groups warned that if the US and China couldn't negotiate a fair compromise, both economies would suffer, hurting manufacturers, farmers, and consumers on both sides of the Pacific. By May of 2025, the two governments were forced to return to the negotiating table. Facing the risk of spiraling tariffs and economic pain, they struck a temporary deal. On May 14, 2025, the US agreed to reduce tariffs on many Chinese imports from 145% down to 30% for a 90-day period, while China lowered its retaliatory duties on US goods. However, this truce was only a temporary relief measure. But crucially, the de minimis exemption for China remained eliminated. Even with lower tariff rates for 90 days, small parcels under $800 from China and Hong Kong still had to go through full customs processing and pay duties. In other words, there was no return to the old system that had fueled Temu and Shein's explosive US growth. But they all knew one thing: that they couldn't give up on the massive US market entirely, even with all their losses, which were significant. Temu's parent company, PDD Holdings, was blunt in its May 2025 earnings call. In response, Temu launched a complete strategy overhaul. Instead of shipping millions of tiny packages directly to American consumers, Temu announced plans to build out US warehouses and require its Chinese suppliers to pre-clear inventory into the United States. That meant paying import duties up front, warehousing goods in the US, and fulfilling orders domestically. It was a massive shift from the asset-light dropshipping model Temu had used to undercut American rivals. The Chinese e-commerce powerhouse had been among the most aggressive buyers of online ads, flooding Facebook and Instagram feeds with an unmatched barrage of promotions. But that relentless ad blitz is now slowing down. According to market research firm Sensor Tower, Temu's US ad spending on Meta fell 10% year over year in the first quarter of 2025. Meta platform still took the biggest share, 68% of Temu's American media budget, but that's down from 76% in 2024 and 2023, when Temu's global ad spend was estimated at a staggering $3 billion globally. Temu declined to comment on these changes. At the same time, its American user base shrank significantly. The share of monthly active users from the US dropped from 30% in 2024 to 15% in Q1 of 2025. App downloads in the US also plunged 40% during that period, dragging Temu's iPhone App Store ranking from first among shopping apps to 11th. The pullback wasn't just on Meta. Temu's share of Google Shopping ad impressions, a good measure of its presence in Google search product ads, fell from 40% to 0 between April 1st and April 12th, according to research by Mike Ryan at Smarter E-commerce. Data from media agency Tinuiti shows it's remained at 0% since then. Meanwhile, Tubular Labs reported that Temu stopped all US-sponsored TikTok videos at the beginning of April, according to Adweek. But beyond these headline figures lies a quieter story about the ripple effects on the entire social media ad ecosystem. Shein, in particular, ramped up its own ad spending to defend market share, as customers chasing fast fashion deals flock to Temu instead. Now, with Temu pulling back sharply, the entire online advertising world is bracing for the fallout. Even with these changes, Temu made it clear that the US was no longer its primary growth market. In fact, by June of 2025, over 90% of Temu's 405 million monthly active users were outside of the US. Countries in Europe, Latin America, and Southeast Asia became its new focus. These markets still offered favorable customs rules and fewer trade restrictions on small-value Chinese shipments, allowing Temu to keep its low-cost model alive elsewhere. Meanwhile, Shein faced a different but equally tough challenge. Shein was better prepared for the crackdown than Temu, thanks to steps it had started taking even before the new rules were announced. For years, Shein had been experimenting with distributed manufacturing, producing clothes not only in China, but also in places like Vietnam, Turkey, and Brazil. The goal was to reduce shipping costs, avoid reliance on Chinese factories, and navigate shifting trade rules. After the May 2025 tariff crackdown, Shein accelerated those plans. This wasn't just about avoiding US tariffs. Diversifying production helped Shein mitigate political risk, reduce supply chain bottlenecks, and adapt to local market demands in new regions. It also helped the company position itself as more than just a Chinese brand, which was strategically important given growing geopolitical tensions. But these moves came with a big cost. Shein's leadership warned investors that profit margins would be squeezed by higher labor costs outside of China and the need to maintain more complex logistics networks. Meanwhile, Shein also began testing US-based warehousing strategies. Both companies, in short, were forced to completely reinvent their US strategies. But this wasn't the end of Temu or Shein, but it was the end of an era where they could flood the US with cheap, duty-free Chinese goods. Retail groups in the US pushed hard to lower the threshold dramatically, or scrap it altogether. By 2024, a bipartisan bill in Congress proposed cutting the limit to as little as $10 or $50 for all foreign sellers, or excluding entire product categories. As of June 2025, no nationwide change beyond a China-specific crackdown had passed. But the debate in Washington was only getting louder, as the loophole's weaknesses had now been fully exposed. It wasn't just about Temu and Shein. Countless overseas sellers had used the same method to flood the US with cheap goods, bypass inspections, and undercut domestic businesses on price. But even there, governments were watching. The European Union had already been discussing tighter import rules to fight counterfeits, improve safety, and ensure fair taxation in e-commerce. It's a new chapter for global e-commerce, one with stricter rules, fairer competition, and higher stakes for everyone. How it will turn out is something only time can tell. Thanks for watching.